A real estate investment trust is a business that owns, manages, or finances income-generating real estate. Real estate investment trusts combine the funds of multiple investors, allowing individuals to invest in sizable, income-producing real estate. Individual investors can therefore earn dividends from real estate investments without having to own, manage, or finance any properties themselves. REITs enable people to invest in real estate asset portfolios by purchasing individual business stock or through a mutual fund or exchange-traded fund. Owners of REITs receive a portion of the revenue generated without having to buy, manage, or finance real estate. REIT promoters raise capital to construct or acquire real estate assets, which they then sell or rent to create revenue. The money earned is subsequently paid to investors as a return on their investment in REITs. A REIT portfolio may contain apartment complexes, data centers, healthcare facilities, hotels, infrastructure, office buildings, retail centers, self-storage, timberland, and other properties. The Capital Markets Authority, CMA, regulates REITs under the Capital Markets Real Estate Investment Trusts, Collective Investment Schemes, Regulations, 2013. Kenya is the third African country to have established REITs as an investment vehicle, with Kenyan REIT rules allowing for three forms of REITs: I-REITs, D-REITs, and Islamic REITs. There are only 10 licensed REIT managers. Kenya has only one listed REIT, the Ilam Fahari REIT, which debuted on the NSE in November 2015. However, the performance of the Ilam Fahari REIT has been declining since its initial listing, indicating that investors' interest in the product is decreasing. An income real estate investment trust, I-REIT, is a real estate trust whose primary source of revenue is rental property. The investors profit from the investments they make through rental income and capital appreciation. A development real estate investment trust, D-REIT, is a real estate trust in which resources are pooled to construct real estate projects. Once development is completed, a D-REIT can be converted to an I-REIT, at which point investors can choose to reinvest their cash, sell or lease their shares, or sell the completed developments. Islamic real estate investment trusts are a type of REIT that only engages in Sharia-compliant activities. Before investing in this form of REIT, a fund manager must conduct a compliance test to guarantee it is Sharia-compliant. The majority of REITs follow a simple and easy-to-understand business model, i.e., the firm earns cash by leasing space and collecting rent on its real estate, which it subsequently distributes to shareholders in the form of dividends. REITs must distribute at least 90% of their taxable income to shareholders, with the majority distributing 100%. REITs can be a significant aspect of an investment portfolio since they provide a high, consistent annual dividend as well as the possibility of long-term capital appreciation. REITs are viewed as a versatile payment option, with investors able to tailor their REITs portfolio depending on fund characteristics, real estate industries, and regional exposures. REITs offer capital gains tax exemption on the sale of immovable property shares in another REIT or shares in a controlled property firm. Shareholders who sell their REIT units on the NSE do not have to pay CGT or stamp duty. Because most REITs trade on public markets, they are easy to acquire and sell, a trait that minimizes some of real estate's conventional drawbacks. REITs provide attractive risk-adjusted returns and consistent cash flow. However, REITs do not provide sizable capital appreciation. As part of their structure, they are required to return 90% of income to investors. As a result, only 10% of taxable income can be recycled back into the REIT to purchase new securities. Other disadvantages include the fact that REIT dividends are taxed as ordinary income, and certain REITs charge hefty management and transaction costs. It might be difficult to ascertain the value of a non-traded REIT share. Non-traded REITs often do not release a value per share estimate until 18 months after their offering closes. Non-traded REITs are illiquid investments. It is more difficult to sell them on the open market. Kenya may begin to enhance the regulation and government support for REITs by enacting policies that encourage real estate investment and aid increased financial flows into the property market. The Kenyan REITs market has the potential for expansion with increasing government backing and public sector awareness of REITs. While REITs in Kenya are still in their early phases, they represent an ideal opportunity for institutionalizing real estate assets. The viability of this asset class is dependent on ongoing involvement by all stakeholders, including regulators, developers, the press, and the exchange, in order to demystify the risks, rewards, and chances for potential investors.